let's get to our live questions that came in. Chuck, you said, good day. When scanning for credit spreads, is there a way to filter out that the net credit you receive is greater than 1/3 of the spread? Man, Chuck, there's no way to do that directly. Okay, but let's talk about this for a moment. So what are we talking about here? We're talking about strategies I took off last week and don't have here. So let me add in bull put credit spread. We'll take out long call for now, but we can always come back. All right, bull put credit. All right, so a way to filter out positions where the credit, wait a minute, did you say filter out? Okay, so where the credit is greater than 1/3 of the spread. Now, of course, what we're talking about here is in any of these strategies now, talking about the main search. You can use a variety of different option criteria and stock criteria for the 23 strategies we support. Oh, SWK is back in there. Okay, so that might be something I might enter Monday if that's still on the list for the weekly bull puts. In any case, you have fields for net credit, percent return, annualized percent return, delta, probability, bid-ask spread, and so forth. The only thing that would come close to what you're asking for, Chuck, that I have advantage of is the percent return. The percent return is defined as the net credit we receive up front divided by the margin, which is usually it's defined as the difference in strikes minus that net credit. Okay? All right, so to look for anything, this is a tough one, Chuck, to look for anything that's greater than 1/3 of the margin, the strike price minus the net credit, that would be a return of 33%, wouldn't it? Anything that where the net credit is greater than 1/3 of the spread means a return of 33% or higher. But we're taking the credit off of that strike prices, so it's lowering down to look at the margin. So if you wanted a credit that's 1/3 greater than the strikes, in the percent return, you might be looking for something that's a 40% return on the position to negate the extra premium coming off, maybe 38, maybe 40% in that case, okay? And that's what we'd kind of be looking for as well. And that would be a way to get started, okay, in that case, to look for those types of returns in that situation, or select, okay, so filter in, or I think you know what I mean, filter in or select, okay? And that's what you might be looking for in that situation, but we're not going to see a lot of 40% returns on positions that are weeklies and that also have the probability target that we want. But let's take a look. What would I expect with a 40% return where the credit is 1/3 or greater than the difference in strike prices? Well, I'm not going to use the weeklies for this one. We're going to clear the filters here. Okay, we're going to start from scratch on our bull put. I'm going to look standard July expiration, 42 days out in time. So I'm going to need a monthly. The actual net credit I'm not going to worry about, but we're just going to put in $1. I'm going to put in a cent return of greater than 38%. I'm still going to want a reasonable probability, Chuck, but I know I have to narrow it down. I'm going to have to start at maybe 65% probability. I'm not going to be at 80. I'm not going to be at 85. All right, looking for that high of a return in that case. Strike difference I'm not going to worry about. So that's all I'm going to look for the options, but let's put in our standard technicals. What am I going to want for a bull put spread? I want to be a stock above an SMA 20. I want some good volume here, at least 750,000 shares per day. I might look for a positive MACD. We're going to skip that. Just basic fundamentals, stock greater than 10, no earnings between now and expiration. I'm going to want something with a positive earnings per share growth. Oh, I am going to go back to the options. Look for something that has an option volume today of at least greater than 0 and an open interest of at least greater than 15 contracts. Okay, let's see what we've got. Yeah, probabilities are right. Oh, the returns are really high though here. Here's an 88.7% return, the 77% probability on Google. And with the stock at 1438, selling the July 1340 and buying the July 1335. So 5-point spread, reasonable. And the midpoint net credit is 235. Now, this is much higher than you were originally expecting, but you do have 70 total results. So this 235 credit is much greater than a third of the difference in the strike prices of 5 points. Further below, we've got a 2.5 point spread at 118. So yeah, that's a little bit, that's about 40%. So it's still greater than a third. So I think that's a good place to start, Chuck, but you're going to be giving up probability to get the return that you want as well. And if you wanted to narrow it down further, you probably limit this 38 to 50. Right, so that takes out those higher ones that have lower probability. Here we see something in the 70% range, $3 net credit on a 10-point spread. That's almost right where you are, right? This last one here on Lockheed Martin. The stock's at 410, selling with July 375 and July 365. But again, I went out to, July to get more time because I know I need more time to get the better credit. But a lot can happen in 42 days with the unknowns that are still out there on the economy and on other situations as well. Okay. All right, let me just scroll here. Okay, William brings up a good point on this. I'm trying to scroll through the notes here and the other comments, and we've got plenty of questions to go through here. So, but you're right. William does say, he brings up a point here, and this is what I was trying to hint at. So, William says, Mike, in Chuck's example, wouldn't the return be 50%? Meaning on a $1 wide credit spread where the credit is 33 cents, the 33-cent net credit would technically be against 67-cent risk. Therefore, the return would be 50% or higher, and that would guarantee the third or greater. Yeah, and you're right. But you see here, targeting that 38% return or higher, we did do that. But yes, you could look at it that way. I see what you're saying. So you could say a 50% return, and on a 2-point spread, that would assume you're at least collecting $1, right? I'm sorry, not $1, but it would be, yeah, about that 75 cents. So if you increase it to 50 or more, now we're just narrowing it down a little bit further, we're back up into those ranges where, again, here's my $2 net credit against a 5-point spread. So it's a little bit higher than that, but 67%. Your point is well taken, William. You're absolutely right. But he asked for a third directly against the spread, not the margin. And so, yeah, it does equate to sort of this 50% return or higher, but there were other ones that still were 1/3 against the spread or greater that were in that lower range of 37, 38% or more. Okay. Okay, so where am I here? I'm going back to the beginning for the gentlemen that have been waiting from the beginning. Then we're going to go through Alex. His question about earnings play. I've been selling Strangles with good success. What is your preferred earnings strategy? The exact opposite. Buying long straddles. I follow Ernie's studies. What he's done, he buys very short-term straddles, usually enters them about 11 to 10 days before expiration, buying just at the money and not worrying about the volatility crush, and he's had a good success rate with that as well. I never do a debit spread, a vertical spread, or a credit spread with earnings coming up to expiration because of the unknown. I don't want to take 100% loss on the stock that drops 15 to 20% on a bull put credit spread because I was probably only 5 or 6% out of the money. Okay, it's not worth it because that one loss, because I have a capped gain structure with the debit spread or the credit spread, is going to be significant. Okay, so I should say I wouldn't do a credit spread. All right. I'm not, probably won't have to worry about the option volume. He says, in addition to that, trade, execution time, entry and exit, option volume, IV, thanks in advance. Okay. The best thing I can suggest to you, Alex, is I thought you had a conversation with Ernie, a coaching session with Ernie. If I'm wrong on that, that's okay. But Ernie's the best one to ask because while I'm putting all of my efforts into the bull put credit spread research and the bull put credit spread product for my approach to trading that, he's been doing the same thing with long straddles for earnings. As a general rule, I would never do a long or short straddle going into earnings, even if I was 10% out of the money on both wings and got a good return, because that one stock that has that unexpected 25 to 35% movement downward or upward is going to cause you so much losses that you probably wiped out the smaller credits that you received, even with increased implied volatility. So I would stick with the long straddle position. And I think what Ernie typically does is he has a search created where he's sort of looking for positions that expire in the next Well, he's looking for positions that have earnings coming up in the next 7 to 8 days, and he's looking for straddles that are beyond the earnings, maybe 10, 11 days to expiration. And what he typically does is exit the position right after the earnings event. He doesn't try to hold it. He actually tested this. He doesn't buy them 3 or 4 weeks in advance hoping for the implied volatility movement and then closing the position before the earnings because the implied volatility increased, because that actually performed worse than simply buying a 7 or 8 day out straddle, waiting for the earnings and then closing it after the earnings event. Yes, you're going to suffer a volatility crush, but more times than not, maybe probably only 55% of the time actually, it's still a lottery ticket in a sense, but 55, 53% of the time, you're going to be taking advantage of those positions that have that 10, 12, 15% jump, which is going to be an 80, 90, maybe 100% return on the straddle, even with the implied volatility crush in that case, because of the lower cost of going shorter term. Okay? So the video here, if you go to the long straddle home, the introduction to straddles, Ernie starts talking about that a little bit, but he hasn't put the full product together. If you get a coaching session with Ernie, Alex, you can ask him about his approach. He's got more details into the finer points of what he's doing. I check in with him maybe once every, no, I check in with him every day, but I check in with him once every maybe 10 days or so about his earnings straddles, his progress, and what he's doing. He's a much better person to ask. I will drop him an email this weekend. Probably won't do it. Yeah, I'll do it tomorrow. If I do it tonight, he won't even see it until tomorrow anyway. But I'll send him an email, Alex, about thoughts, quick write-up or thoughts on the straddles for earnings. And I think I have 1 or 2 videos where I discussed it a little bit too based on his teachings, and I'll look for those too, okay? So, but that's my approach. I don't do a vertical spread, debit or credit. I don't try to take one side because I can lose 100% of what I invested with the wrong move. I personally don't like short strangles for the earnings because I don't want to take the risk when that one special 35, 25% mover hits, and I'd probably be at a large loss that's going to wipe out too many of the previous gains. At the same time, I don't do calendars. I don't do any directional or iron condors even in that case. I'm looking for a long straddle or a long strangle to take advantage of the earnings position, not overly worried about the volatility. Option volume is good to look at, but most of the time when you're nearing even a particular stock that's maybe only trading at $5 with earnings coming up, you're going to have a significant amount of option volume. I was doing testing 4 or 5 years ago as well. Let me just say this real quick, Alex, with Ernie. And I was doing a subtly different long straddle approach, about the same time frame, but I was actually buying mine out a week or 2 after the earnings event to see if there's any events afterwards that could help me if I didn't get the profit that I wanted right away. I wasn't as profitable as him. But during that testing, I tried many things. I tried only looking for straddles where the put-call volume ratio was greater than 1, where the put-call volume ratio was less than 0.9, where the put-call open interest ratio was greater than X, where the volatility skew was such. And what I found is that those gave no clue to add more success to the winners and losers. It did not help. Seeing, looking at it, something that has a high put-call open interest ratio, I saw I had the same success rate as not paying attention to it. It was about the same, sometimes a little bit less. So we tried a lot of things, but Ernie's been trying to develop that masterfully as well. And he's got the insight on that. He's tested it and traded it much more than I have. So I'll put that note and that email to him, Alex. Get back to you.